Hello, I'm John Pearce. Welcome to this investment update. Well, 2026 is not even 2 months old, but it's been a fascinating start with some wild swings in the market. Today, I'd like to talk about what's hot and what's not, and why gold is glittering. I'd like to briefly discuss what's happening in the Australian market. And finally, we'll just touch on how this is all permeating into option returns. Let's first turn to the US stock market, which we all know is the largest stock market in the world and sets the trend. Here's a graph of the S&P 500, and you're probably thinking, where are those wild swings you were talking about? This looks pretty flat, nothing to see here. Well, that flat graph belies the turmoil that lies beneath. And this time, we can't blame the turmoil on Donald Trump. This time, it's all about AI, artificial intelligence. It seems to me that every few weeks, a new AI tool is announced that threatens to revolutionize an industry. The latest big release was Claude 4.5, and this is owned by Anthropic and is a competitor to the likes of ChatGPT. Now, among many other things, Claude is potentially able to automate many of the processes we currently see in the legal profession. The point being that AI is no longer a threat for the distant future. To many, it is a clear and present danger, and right in the crosshairs is the software industry. Getting back to that flat S&P 500, have a look what's happened to the software index. On average, American software companies have lost about 20% of their market value. Think about a couple of the giants. Salesforce, down about 70 billion US. Adobe, down about 38 billion US. There is an old adage that software is eating the world. You know the story when you think about what the likes of Amazon, Netflix, Facebook, Google, etc. have done to their industries. You get the picture. Well, now it's AI's turn to eat software. That's, of course, before AI potentially eats itself. Now, there is an irony here, isn't there? It seems to me that the first big casualty of this tech revolution is the tech industry. And what about those market darlings? Remember the Magnificent Seven? We'll have a look at this graph. In 2026, not so magnificent. All down. The concern here is not so much one of disruption. It's more about the investment they're making and the return on that investment. Last year, about 400 billion US was spent on data center build-out, chips, land, power, etc. This year, that number is about $650 billion. Now, these are really big companies, but that is a lot of money. And the real concern here is what's happening to all that free cash flow. And that cash flow that was previously used to increase dividends, to buy back shares, etc., is now being used on chasing AI glory. Think about Google. Last year, free cash flow around $74 billion. This year, zero. Now, is this all bad news? I personally don't think so. Firstly, I think the sell-off in software is a bit overdone, particularly as it relates to software that's so heavily integrated into business processes that you just can't get rid of it that quickly. And I think Salesforce is a pretty good example. What about all that tech spending? Well, you have to bear in mind, one company's spending is another company's revenue. So everyone benefits. And that is indeed why we are seeing a broadening of the market rally outside tech. This is a very healthy development and once again demonstrates the benefits of diversification. So if the broad market is flat and tech is down, it must mean something is up, and indeed it is. And that's companies related to the resources industry, the energy index, up around 20%. Materials index, up around 17%. Now, why is this the case? Well, there are a couple of reasons. Firstly, companies in those sectors just got too cheap. Secondly, it's what the technicians call the reflation trade. What do I mean by reflation? High growth, higher inflation, and relatively low interest rates. Economies are being allowed to run hot. And in this environment, investors tend to favour real, tangible assets, such as commodities. And what's everyone's favourite? Gold. How's gold done this year? Pretty well. Despite the recent correction, it's up about 15%. Who's buying? We know that we hear all the anecdotes of people queuing up for hours to buy their bullion, and indeed, gold is a popular one amongst retail investors. But who are the really big buyers? Well, take a look at this graph. Have a look what the Chinese central bank is up to. It's buying tens of billions of dollars in gold and selling tens of billions of dollars of US bonds. And they're not the only central bank doing it. As a matter of fact, many of the central banks that are not politically aligned to the USA are doing the same thing. So I see this as much a political decision as an economic decision. And that's why I think it's got some room to run. You might be wondering, what is UniSuper's position on gold? Firstly, we do accept that gold is a store of value, and we do accept that it can behave as a safe haven. But gold does not produce an income. So we think of gold as a currency. Now, we have investment principles. We think about your superannuation as your life savings. So our principles guide what we do. And it steers us away from speculating in currency movements. So yes, it is true that we missed out on directly participating in the gold rally. We have bought gold companies. But in terms of the principles, we've also managed to avoid a disaster because of them. I'm talking about the crypto crash. And of course, Bitcoin is everyone's favorite crypto. And for 2026, the picture is not pretty. Now, unlike gold, we don't think of Bitcoin as a store of value or a safe haven. We don't think of Bitcoin as a legitimate currency. And indeed, if anyone tells me that Bitcoin is just digital gold, I try to nod silently and just walk away. Now let's turn quickly to the Australian market. It's doing okay, slightly better than the US market, up around 2.5%. Our banks, which dominate the market, are doing pretty well because the economy's strong, but it's really the resources that have been the high flyers. BHP, up around 18%. It's incredible. You know, it's about 6 months ago, you couldn't find a buyer for BHP at around $40. Today, you can't find a seller at around $50. As Warren Buffett said, shares are the only thing he knows where people want more of, the more expensive they get. Go figure. The Aussie dollar, the battling Aussie dollar, up around 6% versus the US dollar. So the good news is your overseas trips are a bit cheaper. The not so good news is that international portfolios in Aussie dollar terms are negative. Once again, getting back to the S&P 500, about flat for the year, but that's in US dollars. If we look at that graph in Aussie dollar terms, it's down for the year. Australia is trudging along okay, but there is a party pooper, and that's the Reserve Bank. The Reserve Bank is the first central bank to reverse the course of monetary policy and tighten rates. They're fearing that the economy is running a bit too hot, particularly when inflation's out of their range. I think it was the right decision to make. As a matter of fact, I think it was just a reversal of the decision they made in August to cut rates, which I believe was the wrong decision. And regarding the all-important option returns, well, there's no real surprises here, with returns broadly reflecting market movements. We look at a selection of them. International shares option, slightly down. Australian shares option, slightly up. Our sustainable options are underperforming their standard equivalents, and that's because they are underweight the resources sector, underweight energy, underweight materials, and they are overweight the technology sector. Our balanced option is pretty flat to start the year. Now, it's a long way to go, so I'm not going to get into any predictions about where the balanced option is going to finish for 2026. I will, however, remind everyone that we've had 3 pretty good years, 3 consecutive years of double-digit returns. The chances of another double-digit year are not particularly high. Then again, I did mention that global growth is being underpinned by some major investment super cycles. That's a positive. Either way, I think the rest of 2026 is going to be as fascinating as the start, so please stay tuned. Thank you very much for listening.